Hello everyone and welcome to Tax Shorts. My name is Ayesha Bedwei. I'm the tax leader here at PwC based in Ghana, and today I'm joined by my colleague Sahada Mahama, who's a manager in our international tax business. And today we are talking about the taxation of mergers and acquisitions. Welcome to the episode. So Sahada, welcome to today's episode. Can you tell us a little bit about the taxation of mergers and acquisitions, generally speaking?
Okay, thank you very much, Ayesha. So mergers and acquisition, or M&A for short, is a general term used to refer to the consolidation of companies. A merger typically happens when two or more companies combine their business operations and form a new entity, whereas an acquisition is where one company buys another and no new company is formed. M&A transactions typically have like a seller, that's an entity that's selling assets, or a shareholder that's selling shares. We also have the buyer, which is the entity that will usually buy the assets or shares. And then we have the target, the local entity or the resident company whose assets and shares are being sold. So M&A transactions are typically structured as an asset deal or a share deal. So in an asset deal, the buyer would acquire all of the assets or some of the assets of another company. But in a share deal, the buyer will acquire the shares of another company. So that's an overview of what M&A transactions are.
So with all this buying and selling, there must be some significant tax implications. Perhaps you can walk us through what those are.
Okay, so M&A transactions have income tax implications. There are provisions in the Income Tax Act that taxes gains realized from selling or disposing of assets or shares in a local company. So if a shareholder disposes of shares in a local company, or if a company transfers its assets, there are income tax implications. And if the M&A transaction also results in more than 50% change in the underlying ownership of the local entity, there could be tax implications, including forfeiture of some tax attributes like tax losses and deferred finance cost. However, there are exemptions in the Income Tax Act. So once an M&A transaction meets certain specified conditions in the Income Tax Act, any gains realized will be exempt from tax. So M&A transactions can actually be structured in such a way that the gains realized from that transaction will be exempt from tax. Then secondly, when an investor acquires a company, they technically acquire the assets and liabilities of that company. So there's a risk that that investor could inherit what we call hidden tax liabilities. And so it's very important that a tax due diligence is performed on the local entity that's been acquired to be able to identify and quantify any historic tax liabilities, and also to assess any opportunities that can be available for the local entity.
All right. Well, thank you for that explanation, which made it really clear that there's a lot to be considered. Yeah. And obviously, record keeping is very important to be able to identify and structure accordingly. Now, have we seen a lot of M&A activity here in Ghana?
Yeah, so in the past, let's say past 5 years, we have seen significant M&A activities, especially in the banking industry and also some in the telecommunications industry.
So if you had a crystal ball now, do you predict, or could you predict that there may be a bit of a ramp up in activity in the next few years?
I believe so, because Ghana has a democratic territory, and so a lot of investors are open to bringing their business here. And so I believe that the next few years, foreign investors will be looking to invest in Ghana. And so there'll be quite a number of M&A activities.
Okay, exciting for us as a country.
Yeah.
All right, any last or parting comments you'd like to leave our viewers and taxpayers with?
Okay, so my parting comment is that if you're an investor looking to invest in Ghana, whatever deal you are considering, whether you are considering an asset deal or a share deal, it's very important that prior to closing that deal, you evaluate the tax consequences of that transaction so that a transaction can be structured in a tax efficient way, and also to enable you manage and provide for any potential tax liabilities.
Great, thank you very much. Thank you very much for joining us. Today we're discussing M&A activity, which stands for mergers and acquisitions. My name is Ayesha Bedwei. I'm the tax leader here at PwC Ghana, and I was joined by my colleague Sahada Mahama, who's a manager in our international tax business. See you on the next episode. Thank you and God bless.